Angeline Ong, and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Well, coming up, US CPI. Will the latest inflation reading signal the need for another US rate hike? Yen watch, we're on that too. The finance minister of Japan reiterating the readiness for appropriate FX action. This coming as the yen nears the key 152 level. And the retail focus ramps up in the US with Walmart, Gap, Target, and Home Depot on deck as we count down to Thanksgiving and Cyber Monday. A very good afternoon to you and welcome to this new edition of Beat the Street. Not long now before Wall Street starts trading. In a moment, we'll cross over to Chris Vecchio live in New York. But for now, let's have a look at how equity markets and the volatility index are looking. Volatility meandering near the 16 mark, not very much change there, really, even after. I mean, we saw a slight tick up in the previous few sessions, but really, to be fair, if you look at longer term view, volatility and the volatility index rather has been coming off levels seen quite recently, and definitely quite a far cry from the 2604 seen in around the March period. Let's have a look at what the Wall Street and US 500 are indicating. Wall Street, of course, mirrors the Dow Jones Industrials, and they are all indicating a slightly lower open as investors await that crucial inflation reading. Just showing you the Tech 100 there as well ahead of the open. And what we are looking out for now out of that CPI reading is that either confirmation or actually something that goes quite against what Jerome Powell is indicating, that is that high inflation is still here and that the battle against higher prices, it may not be over yet. Well, to give us a sense of what to look out for and what the mood is like on the ground, let's cross over to Tasty Live's Chris Vecchio. Tasty Live is, of course, part of IG Group. Chris, what are you looking out for in terms of that CPI number?
I'm looking for a sharp deceleration in price pressures. The month-over-month reading is doing around 0.1%. The year-over-year headline is doing at 3.3 from 3.7. That cuts in half about the gains that we had seen from the lows in June when we registered the low tick of the year at 3% on the headline. That's all well and good. And it's a large part due to what's been happening in energy markets, where if you look at gasoline futures, crude oil futures, or Brent futures, for those across the pond, heating oil, natural gas, they've all come in fairly sharply here in recent weeks and months. And so, from that perspective, headline inflation should be lower. It shows us that the bump that we've seen in the second half of this year is largely due to the distorting effects of statistical base effects. And while it doesn't mean we're out of the woods yet, November and December should be turbulent months as well. It does put us on a path to looking at a two handle on headline CPI sometime in the first half of next year. It vindicates the Fed's point of view that they can just sit tight for now, that no further rate hikes are needed.
We're also seeing, Chris, some data points on the annual Medicare adjustment expected to be between 0.4% and 0.6%. Does that mean the overall CPI print for November is likely to be higher?
No, not necessarily, because there are so many different factors that go into the stew of CPI. Moving forward, though, the government spending is absolutely going to be something of an issue for the Federal Reserve to bring down its headline inflation. The United States is running wartime deficits right now to the tune of nearly $2 trillion per year. While this is helping the economy stay afloat and prevent the U.S. from falling into recession, it's also lifting aggregate demand, which is pushing up price pressure. So it's a part of a bigger story right now that ultimately you're seeing a situation where there's a little bit of fiscal dominance here in the United States, and it's difficult for the Federal Reserve to push off against that. They have succeeded somewhat thus far. We'll see if tomorrow bears the same fruit.
And Chris, we've been, really nicely surprised by how resilient the U.S. consumer is, despite the high inflation, despite everything that you've mentioned. But there are now sort of concerns that the consumer, there might be cracks emerging, and we've got retail sales and a lot of big U.S. retail names reporting this coming week. What are you expecting to hear?
It looks like retail sales are expected to decline, but if you strip out the gasoline component of it, then they're not as bad as they once were. Part of the headline retail sales configuration is such that you have money spent at gas stations at the pump, part of that overall figure. So it's important to strip out the ex-gasoline number in order to ultimately arrive at where the more core inflation or where the core retail spending will be. But that's still expected to come in slightly negative, around negative 0.1% month over month. And that shows that the burden of higher interest rates, that the fact that we now have consumers spending more of their money on reservicing or servicing their student debt, that's back in the equation. There has been this bite of higher interest rates filtering through into auto loans, or if it's the housing market. Ultimately, if you look at the consumer, auto delinquencies are up, credit card delinquencies are up the last few months. Higher interest rates are starting to have their effect. It wouldn't surprise me if we see a little bit of weakness there, but then again, that is what the Federal Reserve wants. So it would be a sign that the market could take this and say, okay, we are done with the rate hike cycle.
Thanks very much, Chris. We'll be definitely joining back with you when we get some of these retail figures out. Thank you very much for now, though. As I mentioned earlier, Home Depot, Target, Walmart, Gap, some of the big names that will be updating investors later this week. Let's just have a look at the animation for you, just to show you the breadth of the earnings expected this week out of the U.S. retail sector, especially ahead of that key shopping season. Thanksgiving, of course, is just looming. More than earnings, these group forecasts will be all that matter in the eyes of investors. Of course, the early data already pointing to the slowest holiday sales growth in 5 years. Now, the National Retail Federation says holiday sales, including e-commerce and non-store sales, would rise between 3 and 4% to $957 billion and $967 billion in the month of November and December. Sales last year in these 2 months were up 5.4% and 12.7% in the previous one. So you can see that drop. Let's get back to some of these stocks then. Home Depot expected to earn earnings of $3.76 a share on sales of $37.6 billion. This compares to EPS of $4.24 and sales of $38.9 billion US dollars. Home Depot, like many of its peers, going through difficult times. On the one hand, you've got weakening consumer demand. On the other, you've also got some high input costs that have squeezed margins. Year to date, Home Depot shares have lost some 8% over the past 12 months. The stock is up 1% compared to a 16% rise for the S&P 500. Now, on Thursday, the street is looking out for Walmart to post earnings of $1.51 a share and revenues at $159.3 billion US dollars. In the same quarter last year, earnings came in at $1.50 a share on revenues of 153. That's almost 153 billion dollars. Now, Walmart has been focusing on developing its e-commerce segment. Pretty wise, given that in the last few years, it's been seen that those with a strong online presence tend to have a more robust holiday sales season in the US. In 2019 alone, online sales amounted to just over $25 billion worldwide. And in the most recent fiscal year, e-commerce reached $82 billion or thereabouts. Now, this strategy to refocus on e-commerce for Walmart puts it in a slightly better situation than some of its competitors at a time when bricks and mortar retailers aren't doing so well. Investors, just checking on Walmart, the chart here for you, investors will be looking for any signs of any comments of a shift in consumer behavior. Also, watch out for any comments as to pay later services like Klarna. Any information on physical store performance will also be pounced on by investors to gauge the health of US retailers. Now, watch out for Boeing, because Boeing is also one that is likely to move. Boeing is an all-session stock. As the Dubai Air Show, we're seeing a slight uptick there in its shares, currently up 3.5%. The uptick there coming as the Dubai Air Show opens its doors, and already we could see tens of billions of dollars of orders from the Middle East carriers. Hosts Emirates and sister airline Fly Dubai are expected to get started with a new order for 90 Boeing 777X jets. Now, this deal is potentially worth around $40 billion at list prices. Both Emirates and Boeing have declined to comment, but I can tell you that on all sessions on the IG platform, Boeing shares are currently up 3.5%. Plus, we're also getting the latest details on the latest episode in the conflict between US car makers and the UAW. Ford production workers at Louisville Assembly Plant and Kentucky truck plants have voted 55% against the tentative labor agreement. Skilled trades workers have voted at 69% in favor. Now, the UAW did not disclose the overall percentage of votes in favor, but it gives us a sign that the approval is not yet guaranteed, as more workers in Michigan are likely and have yet to vote. So far, 70.7% of workers have voted in favor of the deal. And just showing you Ford's shares there, because it is also an all-session stock on the IG platform, and it is currently showing a very slight rise of 0.2%. Tyson Foods is expected to fall at the open very shortly after forecasting revenues for its next fiscal year below the street. The company also reporting a mixed report for the third quarter. Now, if earnings come in at 37 cents, beating expectations, well, then revenue fell short of estimates. Tyson Foods is facing headwinds, as you know, from production all the way to distribution. U.S. cattle herds are falling due to drought, and like many sectors, the meat industry has to deal with higher labor and raw material costs. This is pretty much across the board for agriculture. Higher food prices and interest rates have also put pressure on American pockets, and American consumers have been cutting back on meat purchases. Tyson Foods expecting sales to be flat in fiscal 2024 as compared with the total sales of $52.8 billion it reported in fiscal 2023. Just keeping a look out for its chart here. And I can tell you that Tyson Foods, its shares have fallen some 25% year to date. Now, just taking a quick look again at Wall Street for you, there is an indicated, well, pretty cautious open there. Let's take a look at the minute chart for you to see whether we can get a better indication of where it is headed. It is ticking up ever so slightly, but it has to be said that we're still seeing not a lot of conviction there. However, if you look at the chart on a longer term weekly view, it has to be said that we have seen a remarkable rebound since around the September 2022 date, and also another rebound looking at the weekly chart from around the March 2023 date, and the next higher high was, lower high was seen sometime end of October. However, a lot of this does depend on what that CPI figure tells us, and we're counting down to that already. This, of course, after Fed Chair Jerome Powell issued a warning to traders and financial markets that they should not assume rates will be flat to lower for the foreseeable future. Just want to also remind you that benchmark 10-year Treasury yields also pushing to a one-week high of 4.6%. During earlier in the session, testing the top of their recent range since the October chill in the non-farm payroll figures. Now, the CPI figure, just showing you, for those of you who are just joining the show right now, the data will also be one that traders look at, because it does also imply the risk of increased FX volatility in its wake could be surprisingly low. This is according to forex option pricing. The yen, however, is something that's a bit more interesting to watch versus the US dollar. Just pulling up that cross for you, because, as I mentioned earlier, we are creeping ever so much closer to that 152 figure. The Japanese authorities have not yet said anything solid or concrete about intervention, but it is seen as a key figure for the Japanese authorities to intervene there. Now, meanwhile, the S&P 500 has risen a second straight week in seesaw trade after the Fed's hawkish comments, and also the S&P 500 snapped an 8-day winning streak after Powell warned of prior inflation head fake, suggesting that perhaps more rate hikes are possible. Well, what's in store for the Nasdaq? IG's Axel Rudolph has been taking a look at the mega high growth stocks and what that might mean for the technicals for the Nasdaq.
The Nasdaq 100 is really, really interesting, because not only did we last Friday close above the mid-October high at 15,339, thus confirming this major bullish reversal pattern, but we also basically rallied all the way into the late August and early September highs between 15,520 and 15,628. So the Nasdaq 100 has seen a very sharp ascent over the last few weeks on those more dovish interpretations of the comments by Jerome Powell, and on the expectation that we might no longer see an interest rate hike in this cycle in the US. And given the strength of the upside momentum, this V-shaped reversal we've also seen from a technical perspective, it looks to me pretty likely that we will, in the next few days, test the early September high at 15,628, but then also continue our advance towards the July high at 15,932, and perhaps test the psychological 16,000 mark with regards to the Nasdaq 100. Now, there is a caveat, though. If we were to suddenly revert to the downside and fall through last Thursday's low and close below that, here it was made at 15,139, then we would have to question our bullish view with regards to the medium term.
Thanks very much, Axel. And just checking in on oil for you as well, because oil price is holding steady currently in the session because the market is offsetting waning demand in the US and China with mixed signals from the Fed. Saudi Arabia and Russia also continue the voluntary oil cuts, also set to continue these cuts to the end of the year. What is interesting is if you look at this chart of mine here, it's a bit messy at the moment, but I'm trying to show you that for those who expect prices to rise, there's quite a clear trend line there heading higher, showing that since March we've seen an increase in US crude of around 23%. However, it has come down. There's another longer term trend line there. I'm trying to show this to you by measuring from the top of March 2022 downwards, and that is looking at the moment like a fall of around 41%. If you think that demand is going to be the key driver for oil markets in the months ahead, then it's this that you want to look at, because it is down 41% and we still have no indication that demand is going to pick up from China and the US, both big consumers of energy. And on Friday, the US weekly oil rig count fell by 2 to 616, a decrease entirely down to the number of oil rigs in operations, down to 494. So on the supply side, there's also quite an interesting picture there developing. And just a reminder, we are also set to speak to Justin Urquhart-Stewart, who is one of the biggest names in the city. He's going to talk to us about all these factors, the Fed, the CPI figure, retail, and also, of course, energy prices, and what this all means for 2024 and where the opportunities and risks lie. He's the economist and chairman of Regionally, Justin Urquhart-Stewart, and we'll be having him on tomorrow for a special interview and podcast. Before we go, a quick reminder of where we are in terms of US stocks. They're looking likely to have quite a tepid, cautious open. No surprise, really, given we are counting down to those CPI numbers after a hawkish Fed. Until then, that's it for this edition of Beat the Street, the show that follows all the trading action, helping you position yourself ahead of the opening bell. For more trading insights, do follow me on @IGCom and @Angeline Ong on Twitter. This is IGTV.